You've probably felt it. That quiet rumble under the financial world that suddenly turned into a thunderous shake. Imagine waking up one morning to discover that the largest asset manager on earth just moved 2.5 trillion out of America. Not a small fund, not a boutique bank, the behemoth whose fingerprints are on nearly every corner of the global financial markets. Today we're unpacking why BlackRock made this historic shift, what it means for the US, and most importantly, how it might affect your wallet, your retirement, and your future. This isn't just a headline, this is a seismic reallocation of wealth, the likes of which we haven't seen in decades, and understanding it could be the difference between financial stress and financial confidence in the years ahead. Brr. Right now, we're going to explore this topic from the ground up, starting with the why, then moving into the consequences, and finishing with actionable insights for you. But first, let's paint the big picture. BlackRock is not a small player on the field. With approximately $10 trillion in assets under management as of last reporting, it's larger than the GDP of most countries. Think of it like the Amazon of global investing, not just influential, but foundational to how money moves around the world. When BlackRock moves, markets feel it. When BlackRock whispers, traders and policymakers listen. So when it reallocates $2.5 trillion out of US assets, that's not a whisper. That's a shout heard around the financial world. Understand what happened? We need to go back to the last decade of ultra-low interest rates, easy money policies, and central bank interventions. After the 2008 financial crisis, the Federal Reserve slashed interest rates to near zero and kept them there for years. This was designed to stimulate the economy, and it did, at least on paper. Stock prices soared, credit was cheap, and asset valuations climbed to record highs. But over time, cheap money caused distortions. It pumped up asset prices faster than earnings could justify. It encouraged risk-taking. And eventually, as natural economic cycles do, inflation reared its head. By 2021 and 2022, the Fed was forced into a dramatic pivot, raising rates faster than in several previous decades combined. As rates rose, bond prices fell, stock valuations adjusted, and the cost of capital shifted. Suddenly, the clarity of the old regime gave way to uncertainty. This brings us closer to the present moment. BlackRock, with its sophisticated analytics and global reach, began signaling a strategic shift as inflation persisted and geopolitical risks increased. The composition of its portfolio started to change. The $2.5 trillion movement wasn't a simple sell everything and run. It was a carefully calibrated rebalancing driven by data, risk assessment, and long-term forecasting models. They began reducing exposure to traditional U.S. equities and bonds, simultaneously increasing allocations to international markets, commodities like precious metals and energy resources, and alternative investments that thrive in inflationary or uncertain environments. This wasn't a short-term trade. It was a strategic response to changing macroeconomic realities. Now you might be thinking, okay, so BlackRock rebalanced. Big deal, they do that all the time. But here's the twist. The scale and the direction of this move are unusual. Historically, large institutional investors have favored the U.S. markets for stability and liquidity. U.S. Treasuries are considered the global risk-free BR benchmark. U.S. equities have historically outperformed most others over long periods. But in the past year, BlackRock's models began to show diminishing expected returns in these traditional assets. Meanwhile, emerging markets offered cheaper valuations, strong demographic trends, and accelerating productivity. Commodities, especially gold and silver, were signaling strength as hedges against currency debasement and rising inflationary pressures worldwide. BlackRock didn't move because of panic, it moved because probabilities changed. Unpack what that means. When big institutional players reposition assets, they're not just moving numbers, they're responding to four interlocking forces: interest rates, inflation trends, geopolitical dynamics, and global growth differentials. Higher interest rates in the US had already put pressure on corporate borrowing, housing markets, and consumer spending. At the same time, fiscal deficits continued to balloon, raising questions about long-term sustainability. Meanwhile, other regions, especially parts of Asia and the Middle East, were experiencing strong capital inflows, rapid industrial expansion, and growing internal consumption. BlackRock saw these trends and adjusted its sales accordingly. Of course, this shift has a psychological impact on markets as well. When investors see a behemoth like BlackRock reducing U.S. exposure, uncertainty can ripple through retail and institutional investors alike. Markets aren't just driven by fundamentals. They're driven by expectations, confidence, and perception. If enough players begin to question the traditional dominance of U.S. markets, capital flows can accelerate in unpredictable ways. That's why financial commentators are buzzing. This is not simply a portfolio adjustment, it's potentially a reconfiguration of global financial gravity. Now let's talk specifics. Where did that $2.5 trillion go? A significant portion flowed into international equities, particularly in fast-growing economies with expanding middle classes and robust manufacturing bases. Another chunk went into commodities, with precious metals like gold and silver seeing renewed interest as traditional hedges against inflation and currency volatility. Even within commodities, the story gets nuanced. Gold might serve as a store of value, while silver has dual roles as both a store of value and an industrial metal crucial for green technologies like solar panels and electric vehicles. BlackRock's strategic increase in these areas signals confidence in their long-term demand. It didn't stop there. A growing share of capital moved into real assets such as infrastructure, renewable energy projects, and private credit, sectors less correlated with traditional market swings and potentially offering stable income in a high-rate environment. And yes, there was still some allocation back into U.S. markets. It's not an abandonment, but a reshaping of exposure based on projected growth and risk assessments. So what does all this mean for you? Let's bring it down to everyday terms. When major asset managers shift capital, it affects interest rates, stock valuations, retirement accounts, and even consumer borrowing costs. For example, if demand for U.S. Treasuries decreases, yields might need to rise to attract buyers, which could translate into higher borrowing costs for everything from mortgages to auto loans. If commodity prices climb due to increased allocations, energy and material costs could ripple through the economy. And for everyday investors, the ripple effects could show up in your 401k, IRA, or brokerage account. If your portfolio is heavily weighted in traditional U.S. stocks and bonds, you might be overly exposed to the very risks BlackRock is repositioning away from. On the other hand, if you have diversified into international markets or precious metals, you may be better positioned for the changing landscape. But don't jump the gun. Diversification is not a magic bullet, and timing markets rarely works long term. Let me ask you this. What would you do if you knew the general trend of capital flows before they fully materialized in market prices? Would you adjust your retirement strategy? Would you reevaluate your exposure to different regions? These are not hypothetical questions. They are the real conversations happening inside boardrooms and investment committees right now, and understanding them gives you an edge. Bar. Why BlackRock moved $2.5 trillion out of America isn't about fear. It's about context, trends, and informed decision-making. And as we look forward, we'll dig deeper into how this shift may unfold, what historical precedents tell us, and how you can think about opportunities and risks as the global economy enters a new chapter of capital realignment. Right now, what's clear is that investors, large and small, are asking questions that didn't exist a decade ago, and the answers may redefine how wealth is built in yield in the coming decades. The first thing to grasp is that this massive reallocation by BlackRock is not happening in isolation. It is part of a broader shift in global capital flows that has been quietly building for years. Historically, the U.S. enjoyed an almost magnetic pull for international capital. Investors around the world flocked to American stocks, bonds, and treasuries because of their stability, transparency, and liquidity. The U.S. dollar itself became the world's primary reserve currency, giving the country a unique advantage. Other nations were effectively subsidizing American debt by holding dollars. But now, cracks in that long-standing advantage are emerging. Rising interest rates, growing national debt, and competition from other markets are slowly eroding that gravitational pull, and BlackRock, with its sophisticated forecasting models, is responding accordingly. Analyzing these flows, it's critical to recognize the role of emerging markets. Countries like India, Brazil, Vietnam, and parts of Southeast Asia are experiencing rapid economic growth, urbanization, and technological adoption. They are creating consumer bases larger than most Western nations and developing infrastructures that facilitate investment. From a macroeconomic perspective, these countries are offering potentially higher growth rates and valuations that appear cheaper relative to mature markets like the U.S. BlackRock's pivot toward these markets is a strategic acknowledgement of this reality. The firm is positioning itself where capital has the highest probability of long-term return relative to risk. Another layer to this story is commodities, particularly precious metals. Gold, silver, and increasingly, metals critical to green energy technologies like lithium and copper are becoming strategic assets. Why? because they provide a hedge against inflation, currency depreciation, and geopolitical uncertainty. Gold has historically been a safe haven during crises. It does not promise yield like bonds or dividends like stocks, but it preserves value when fiat currencies falter. Silver, on the other hand, offers a dual role. It's both an industrial metal and a store of value, which means its price dynamics respond to both macroeconomic trends and technological demand. BlackRock's increased allocation to these assets signals an anticipation of continued economic volatility and a bet that tangible, scarce resources will outperform pure BR. Why financial instruments? The consequences for U.S. markets are profound. If trillions of dollars move abroad, even incrementally, it can impact equity valuations, bond yields, and investor confidence. Take U.S. Treasuries as an example. Traditionally considered risk-free, Treasuries underpin global finance and influence everything from mortgage rates to corporate borrowing costs. If demand for these instruments decreases because major institutions like BlackRock are reallocating capital elsewhere, yields might need to rise to attract other buyers. Higher yields, in turn, increase the cost of borrowing across the economy, potentially slowing business expansion and consumer spending. This chain reaction illustrates the interconnectedness of global finance. One strategic move by a major asset manager can ripple through countless layers of the economy, subtly reshaping growth trajectories. It's also worth noting that retail investors often feel the effects indirectly. For example, if your retirement account is heavily weighted toward U.S. equities, the valuation pressures caused by large outflows could depress your portfolio in the short term. Conversely, those who have diversified internationally or allocated to commodities may see relative stability or gains. But this isn't merely about chasing the latest trend. It's about understanding long-term probability, correlation, and risk management. BlackRock isn't moving capital haphazardly. It's applying decades of market data, predictive algorithms, and risk modeling to navigate an increasingly complex global landscape. Observing their strategy provides insights into broader market currents that can inform your own financial planning. Now, let's zoom out and consider the geopolitical dimension. International capital is influenced not just by economic fundamentals, but also by politics, trade agreements, and regional stability. For instance, nations with stable governance, transparent regulations, and favorable tax policies naturally attract investment. BlackRock's international repositioning suggests confidence in regions where political risk is manageable and where economic growth is projected to outpace stagnating U.S. sectors. Similarly, tension between global powers, whether in trade, technology, or defense, can alter the perceived risk of certain markets. Investors are acutely aware that sudden sanctions, tariffs, or conflicts can dramatically affect returns, and BlackRock's diversification strategy reflects an effort to mitigate such exposure. Essential concept here is correlation. In finance, correlation measures how assets move relative to each other. Highly correlated assets rise and fall together, while uncorrelated assets move independently. By reallocating to international equities, commodities, and alternative investments, BlackRock reduces correlation within its portfolio, meaning that a downturn in one region or asset class is less likely to drag the entire portfolio down. Principle of diversification is simple, yet profound. It allows investors to protect wealth against unexpected shocks while still seeking growth opportunities. Speaking of alternative investments, infrastructure and renewable energy projects are gaining traction as capital destinations. Unlike stocks or bonds, these assets are tangible, often income-generating, and less tied to traditional market volatility. Renewable energy, in particular, is benefiting from global policy initiatives and consumer demand for cleaner technologies. BlackRock's allocation here is a nod to the long-term secular trends that could drive steady returns over decades, while also contributing to portfolio resilience in uncertain times. ETs not overlook the psychological component. Markets are not purely rational. They are influenced by sentiment, expectations, and herd behavior. When investors observe a titan like BlackRock reducing exposure to U.S. assets, it signals that even the most data-driven institutions are reassessing risk. This can amplify market reactions, causing short-term volatility as other investors follow suit, whether consciously or subconsciously. Recognizing this dynamic is crucial. While the headline might read like a crisis, the underlying reality is a strategic recalibration based on evolving probabilities, not panic selling. What does this all mean for you as an individual investor? The takeaways are clear but nuanced. First, diversification across asset classes and GBBR. Geographies is no longer optional, it's essential. Second, understanding the drivers behind macroeconomic shifts, interest rates, inflation, geopolitical risks, and global growth patterns, empowers better decision-making. Third, staying informed about how large institutions like BlackRock allocate capital provides clues about where the market is heading and how you might position yourself to preserve and grow wealth. In practice, this could mean re-examining your portfolio's allocation to US versus international equities, evaluating exposure to commodities like gold and silver, and considering alternative or real assets that offer protection against inflation and volatility. It also means recognizing that the traditional US-centric investment mindset is evolving, and strategies that worked in the past may need adjustment in light of shifting global dynamics. We move further, it's important to anchor this discussion in historical context. Similar large-scale capital reallocations have occurred in the past, though rarely at this scale or speed. In the 1970s, for instance, global shifts in oil markets and currency values led to dramatic investment reallocations. In the 1990s, the rise of emerging markets, particularly in Asia, reshaped global equity flows. What's happening now is a continuation of these historical trends, but amplified by unprecedented data access, algorithmic trading, and the sheer scale of assets under management in today's financial ecosystem. Observing patterns from history can help us anticipate potential outcomes without succumbing to alarmist thinking. The common thread across all these examples is that capital seeks efficiency and growth. BlackRock's $2.5 trillion move is simply an institutional expression of that principle. It's a signal that global economic gravity is shifting, that the US no longer enjoys the unquestioned dominance it once did, and that investors everywhere need to pay attention to changing fundamentals. As we look forward to the next chapter, we will examine the practical steps, opportunities, and strategies that individual investors can adopt in response to this shift. We'll break down tangible ways to hedge against risk, identify growth areas, and position portfolios for resilience. We'll also delve into how precious metals, international equities, and alternative assets can play complementary roles in a modern investment strategy. Understanding this, after all, is not about chasing fear, it's about preparing intelligently for a world where capital flows are evolving faster than most headlines can capture. The final word here is capture, which will lead us naturally into part 3, where we explore concrete strategies, risk management, and what this massive reallocation means for your personal financial decisions. Capture the opportunities hidden within these massive shifts, you first need to understand the principles guiding BlackRock's moves. At the core, it's about risk-adjusted returns, seeking the highest possible return for the least exposure to unforeseen shocks. For individual investors, that same principle applies. It's not about chasing the flashiest growth or panicking over headlines, but positioning your portfolio to benefit from structural trends while protecting against systemic risks. One of the most practical ways to think about this is through the lens of allocation, diversification, and timing. Let's start with allocation. The $2.5 trillion movement demonstrates the importance of geographic and sectoral allocation. BlackRock isn't abandoning the US, it's reducing overexposure relative to potential risks while increasing investments in markets with higher growth potential. For example, emerging Asian markets are experiencing demographic growth, urbanization, and technological adoption at unprecedented rates. Companies in these regions are scaling fast, offering potential returns that may surpass mature US markets over the next decade. Likewise, commodities like gold, silver, and critical industrial metals are increasingly attractive as hedges against inflation and currency risks. By allocating capital across multiple regions and sectors, investors can reduce vulnerability to any single market downturn while maintaining growth potential. XT is diversification. Diversification is often spoken of, but rarely executed effectively. Many investors believe that simply holding a mix of stocks and bonds is enough. BlackRock demonstrates a far more sophisticated approach. It diversifies across geographies, asset classes, and even instruments within each asset class. For instance, within commodities, BlackRock's portfolio might balance traditional safe haven assets like gold with industrial metals crucial to renewable energy, capturing different drivers of value. Similarly, international equities are chosen not only by country but also by sector and company fundamentals, considering political stability, regulatory frameworks, and technological advancement. Applying a scaled-down version of this strategy can help everyday investors protect wealth without the need for trillions of dollars. Timing also matters, but not in the way most people think. Many retail investors try to time the market, buying low and selling high, but this is notoriously difficult. BlackRock's approach isn't about daily or weekly market timing, it's about long-term trend alignment. They anticipate how economic cycles, monetary policy, and global capital flows will evolve over years, not days. For individual investors, this reinforces the value of long-term planning, regular portfolio rebalancing, and staying informed about macroeconomic shifts that may affect risk-reward profiles. By aligning investment strategy with long-term trends, you reduce reliance on luck and increase the probability of favorable outcomes. A tangible way to apply these lessons is through precious metals. Gold and silver serve as more than just stores of value. They are strategic tools for portfolio protection. Historical data shows that during periods of inflation or currency volatility, gold often outperforms traditional financial assets. Silver adds an industrial component, as it is vital to electronics, solar energy, and electric vehicles. Allocating even a modest percentage of a portfolio to these metals can provide balance, acting as a buffer against market shocks while retaining potential for upside. Importantly, precious metals are also liquid, meaning they can be converted to cash if needed, adding a layer of financial flexibility. International equities are another opportunity. Countries outside the US are not only growing faster in terms of GDP, but are also expanding middle classes and domestic consumption, creating multiple avenues for corporate profitability. BlackRock's strategic pivot highlights sectors like technology, consumer goods, and renewable energy in these markets, demonstrating that diversification is as much about quality of growth as quantity. For retail investors, this might translate into considering ETFs or mutual funds that offer broad exposure to international markets while being mindful of currency risk, geopolitical factors, and sectoral balance. Alternative assets, such as infrastructure, private credit, and renewable energy projects, round out this diversified approach. These assets provide tangible value and steady income, often less correlated with traditional equities and bonds. BlackRock's move into renewable energy, for example, reflects confidence in long-term secular trends. Governments worldwide are incentivizing clean energy adoption, and technological advancements are reducing costs and increasing efficiency. Retail investors can capture similar benefits through green bonds, infrastructure ETFs, or selective private investments, adding another layer of resilience to their portfolios. It is also important to consider the psychological aspect of investing. Massive reallocations like BlackRock's can generate fear or uncertainty among retail investors. Headlines may scream U.S. markets in decline or institutional investors fleeing America, but such narratives often exaggerate short-term risk while ignoring the underlying fundamentals. Understanding that these moves are calculated, probabilistic, and long-term helps investors remain rational. Emotional decisions driven by fear or greed often lead to suboptimal outcomes. Observing institutional behavior, without blindly copying it, provides insight while maintaining the autonomy needed for prudent financial decisions. Other subtle but critical lesson is the importance of liquidity management. BlackRock's massive scale requires precise liquidity planning, ensuring assets can be moved without destabilizing markets. While individual investors operate on a different scale, the principle is the same: maintain sufficient liquidity to meet obligations, manage risk, and take advantage of opportunities without being forced into disadvantageous sales. A well-planned cash or liquid asset buffer can prevent panic selling during periods of volatility, preserving long-term capital growth. As we assess these strategies collectively, a pattern emerges. The most successful approaches are adaptive, diversified, and informed by global trends. BlackRock's $2.5 trillion move is emblematic of a larger shift in financial gravity, a recognition that risk and opportunity are constantly evolving across geographies, asset classes, and political landscapes. For investors, this translates into actionable steps: diversify internationally, allocate strategically to precious metals and alternative assets, manage liquidity, and stay informed about macroeconomic trends. It's crucial to emphasize proactivity over reactivity. Many investors only act after market shifts are widely reported, often missing the chance to position themselves advantageously. Understanding the rationale behind institutional moves allows for proactive portfolio adjustments, thoughtful risk management, and the ability to leverage emerging opportunities. This doesn't mean chasing every headline or attempting to mimic institutional trades exactly. It means using information wisely, aligning investments with long-term trends, and making decisions based on probability and risk assessment rather than emotion. In essence, the lessons from BlackRock's move are clear. The U.S. is no longer the automatic default destination for global capital. Growth opportunities abound outside traditional markets, and a balanced, diversified approach is more critical than ever. Investors who internalize these insights, who understand the interplay between macroeconomic shifts, asset allocation, and market psychology, will be positioned to navigate the coming decade with confidence and resilience. BR.